A very good morning to everybody. Welcome to the All New Flow Show. For those who haven't joined us the past week, we did a sort of soft launch for the guys and girls in the ForexAnalytix platform. And this week we're open live to everyone. So very good morning to you all. Thank you very much for coming. Just to run you through the format for the show, we're going to put through talk about a lot of the news that maybe happened overnight, pick out the choice breaking headlines, big market making moves, anything of interest really. We'll go through the countries and then we'll have a look at the pricing and see what's going on in markets generally. I tend to follow a very fundamental view of markets myself. That's the way I trade. I'm very heavy into the fundamentals, so I'm going to hope to bring a lot of that into this webinar, this show. I want a lot of input from you guys and girls, as I've spoken about before. This show is really for you guys. It's not just about me to sit here waffle on all day long. So I want your input. I want your questions. I have them ready for me. Nothing too complex, please, as it's a Monday morning. But had a heavy shift and a bit of a rough night last night. We had a big storm passing through the south of the UK here, kept me awake. You know, lots of thunder and lightning, setting off car alarms and so on and so forth. So keep your questions light today. Like it nice and easy on a Monday. But again, welcome. Thank you for coming to the show, and let's kick off. We're going to start in China. We had some bit of ugly data out overnight. Industrial production fell 2.9% year on year. That was versus plus 5% prior. Although the year-to-date number came in at plus 4% versus 6.5% prior, so not too bad. But we are starting to see signs of the lockdowns impeding the Chinese economy there. Retail sales were terrible, down 11.1% year on year versus minus 6.1 expected prior, down 3.5%. So a big drop there in retail sales. Naturally, obviously we're hearing Beijing now is moving further into lockdowns. We also got some in the market was expecting a change to the MLF rate, which is the medium-term lending facility. That was left unchanged overnight. But we have previously seen they've been a cut in mortgage loan rates by 2 pips to 4.4%. And China's expected to continue its easing path. So that's saying we need to watch as well whether they actually go heavy on main rates or the reserve requirement ratio, which is a big one that everyone looks at. As I mentioned, we are seeing some other weaker data with that unemployment rate that rose to 6.1% versus 5.8% prior. So we're seeing this weakness now becoming borne out in the data. And as mentioned, we had headlines that Shanghai was opening a bit more, easing restrictions a bit more, but they're doing it very cautiously and they're keeping the strict controls in place. Beijing extended their work from home, and also today they've introduced another 3 rounds of mass testing from today. So you know the capital city's really under the cosh, and whether that goes into really tightened lockdowns, then we're going to see more worries about China, supply chains, inflation, and things like that. So that's something to keep an eye on in China at least. Moving to Japan, we had Bank of Japan's Kuroda in Parliament. Pretty much the same chat we've heard recently, watching FX, keeping an eye on its impact on markets, things like that. Sorry, let me just shut up my live squawk there. Yeah, pretty much talking the same old lines. Nothing really changes. They're going to ease as far as they want to. There was some data out overnight from them as well. The corporate goods price index, which is pretty much their PPI, that rose 10% versus 9.5% expected year on year. 9.45% prior year on year. So some inflationary pressures still building up there, but according to the Bank of Japan, it's not quite sustainable enough inflation for them to change their monetary policy, and that's what the market is now guessing about the Bank of Japan. Are they going to start to move? When are they going to start to move? When are they going to believe that inflation is here to stay? And we'll have to see that borne out in the data. Just a quick heads up for Australia. They've got their federal election this Saturday, the 21st. So pretty much a pretty much a general election. I've put that in the room. Those of you in the platform, we've got a lot of news items there. I'll show you that quickly. We've got a little bit of a rundown cheat sheet, if you like. So in the newsroom there, just something on the general election there, what they need, what the state of the election's looking like, who's in charge. It's a coalition at the moment. So there could be some swings there depending on how it turns out. For trading wise and for the Aussie dollar, indecision is what really going to spook markets or cause pressure on the Aussie dollar. So if we get to a situation of a hung parliament, that's going to be pretty negative for the Aussie dollar. But that's coming up on Saturday, so a bit of a way to go before we see what's happening there. Just looking around some of the other countries, UK, we got headlines from the press over the weekend, late yesterday, that there's pressure on the Bank of England from the government and from cabinet ministers, some cabinet ministers, over their handling of inflation, why they haven't combated it sooner or been harder to fight inflation, and their general handling of it. Now, that's coming ahead of a Treasury Select Committee meeting today where Governor Bailey and a few of his other cohorts are going to be grilled over their handling of inflation and monetary policy in general. So we've had these newspaper headlines coming out ahead of that today. That starts at 14:15 GMT this afternoon. So that's something to keep an eye on. We'll have a live link for that on the room. Just moving over to Europe, we've had the EU Commission cutting growth forecasts for this year. They think the economy is going to grow 2.7% versus 4.0% in their prior forecasts. 2023 has been chopped a little bit too, and they're raising CPI forecasts. No surprises there. We've been looking at the euro and the ECB over what they're going to do with monetary policy. I'll touch on that in a second. But those forecasts will sort of play into the ECB's thinking. They obviously do their own staff projection for the Eurozone. So we'll see what those come out next. From the ECB members themselves, we had hawkish member Holzman. He was out this weekend saying that he expects 3 rate hikes this year with more to come thereafter. We're starting to get talk of, as we did with the Fed, with this neutral rate where they see inflation, where they see rate hikes potentially going to and then pausing. His rate is around 1.5%, but he thinks perhaps they need to go above that depending on what inflation does. There's more talk growing about this new tool that the ECB, the spread control tool that they're talking about, where if markets become unsettled, if bond markets become unsettled, they're going to develop a special tool to keep spreads from blowing out. And that's something we need to keep an eye on when we get any information on that, what exactly it's going to look like, what situations it's likely to be used in, and obviously then what impact that may have on markets. I've no real analysis to give on that until we get a bit more detail on that, but it's something that's growing. We've also had French central bank governor and obviously ECB member Villeroy. He's expecting a decisive June and an active July, I think with his exact words. So what he's setting out is that we're going to get in June the plan for what the ECB are going to do in July. We know it's nailed on now that they're going to end QE. So it's likely what's happening now is they're going to announce that in June, maybe to end QE beginning of July. So put a date on that. And then that gives them the 3 odd weeks until the 21st of July ECB meeting to then talk about whether they're going to hike rates. But the focus is now on June about what we get and how Lagarde's going to set that out. Is she going to set out a rate hike for July, playing to the hawks, or will she leave to the doves and maybe push that out a bit further, or not be so committal about a rate hike in July? From the market's perspective, it's pretty much set now. We're going to get noise in June. We're going to get action in July. What that is, if that gets a rate hike, that's going to follow market expectations. So the risk now is building that they under deliver in July, or rather in June, they under deliver for July. So all part of central bank trading and what is going to be moving markets, what we need to listen to. So we're probably going to get a ton more ECB heads giving their chapter and verse on it. So we'll just wait to see if it becomes a bit clearer how strong a high possibility is for July, or whether it's maybe going to be pushed out a bit further. The next meeting after that isn't until September, because obviously they shut down for the summer. So if they don't do anything in July or signal anything for July, then it's going to be for September. That might disappoint the market a little bit with its expectations. Moving on to the US, not much news out at all. So pretty much going to look at what data. Today we get the New York Fed or the Empire State Manufacturing Index. This is the first of the manufacturing data for the new month. So it's a bit of a bellwether. It follows, like a PMI really, the details. So we're expecting for the main number to come in at 17.0 versus 24.6 prior. Tomorrow we get US retail sales. That'll be closely watched, obviously, because the market is now wants to see, is Fed policy going to start impacting the economy? Something we speak about a lot in the room and last week's meetings. On Wednesday, we've got UK CPI, inflation, always the hot topic. Also, we get US housing starts and permits. I want to be seeing whether we're going to start to see a negative impact from Fed policy creeping into the housing market. We've had those signals from the NBA mortgage data that I watch. So let's see if that's going to start creeping into the main numbers, because this is now housing data starting from April. Also on Wednesday, we've got Canadian CPI. Again, the inflation picture for the Bank of Canada there. Thursday, we've got more US housing data with existing home sales. Friday, we've got Japanese CPI and UK retail. So there's a little bit of a heads up for the data to come this week. So let's have a quick look at markets now. So we've had, as I said, these ECB members talking up action over June, July, what's going to happen. We've seen yields in the Eurozone, ticking up a little bit, still obviously quite a way down. If we look at 10-year government bonds there in Germany, still down over the highs we got to, but creeping up again. That's fed into the euro, obviously. We've got some more heavy hitters talking hawkishly over the ECB. So we've had this move back up above 104. We had a little bit touches under it going into Friday, but it was more or less holding. We got above sort of this 104.20 minor resistance we've got up here, pushed up to the next level near 40s. We're in one of those situations where it's the 20s that means something is pair. So we saw something at 104.20, seen something at 104.40, probably see something at 104.60, 80, up to 105, that sort of thing. That tends to happen when markets are moving, but not really looking to go anywhere really new or really push on. So these are all small steps in the bigger trend, until we get back above that 105 level. All these moves at the moment are still very, very small. So it's not out the woods that we, in fact, get another move lower. But with all these ECB members now pushing towards action from June, July, I tend to think that perhaps we're going to get a little bit of some bottoming action in euro dollar here, potentially moving to a dip buy scenario generally in the market rather than a rally sell. But as we can see, we're not pushing on any great degree. 30, 35 pips, 40 pips a range today, still not really a lot. So the market's not really taking off, and we're not really ready to switch the narrative yet to a strong ECB. So I was looking at on Friday, I took a long trying to catch the break above the 85 handle. Unfortunately got stopped out overnight at 84.75. I was long 85.05. Seen that push on. This is more a pair euro sterling that I'm looking to play the central bank divergence between the ECB and the Bank of England. Obviously the pound's been under immense pressure. of late. So we've seen this move higher, but again, we're not getting up anywhere close to this 86 level, which on a longer term basis, I've been looking at for quite a while. We've had this big Fibonacci level here, the 38.2 of the drop from up near the 92s or up in the 92s, around at 86. This was a big level for me. I thought we might be getting a break of it, but that was a quick turnaround, a fake out. So for me, the level is still strong. This is still, at the moment, my main marker for whether we're going to start to change this trend that's been running for nearly 2 years now. I'm long, for those that don't know, I'm long down below 83 and 83.50. So I'm just trying to look to build a position, and I tried that, as I say, on Friday. Took a short-term trade, just testing that broken resistance that we had here around the 84.80, 85 handle. It looked like it was holding on Friday. I got stopped out in the low liquidity levels overnight. I haven't re-entered as of yet. I want to see what happens in the next day or so here. I may look to get in back in at 85, or just leave it alone and see if we get a bit of a dip lower. Conversely, I will be looking again maybe for a break trade above that 38.2 fib at 86. And I can play that both as a short-term trade and then to potentially roll some into the core long position. I'm going to take a quick look at cable. Still sucking. There's not much reason to be long the pound at the moment. As I say, we've got this risk from Bank of England's Bailey. He could. What happens at this Treasury Select Committee is you get a load of MPs from across parties, and they're going to be really, I think today, they're really going to take him to task on this. So it's going to be a question of whether the market feels like he's going to be pushed into tightening further, and indeed what the risks of that might be. And as we've seen from a lot of central banks who are in hiking positions, the Bank of England, the RBA, the RBNZ, etc., their currencies aren't really moving as if they're tightening policy. Usually when you get central banks turning into a hike cycle, the currencies tend to gain. Now, a lot of that move tends to be on the expectation, which can be written in for some of these pairs well before they actually start hiking. And we saw that pretty much in the Aussie dollar and the Kiwi, to some extent even the pound. But it's been the after effect that has been the problem, where we've seen a lot of these currencies lose. A lot of that is down to obviously what's going on in the dollar, but as far as cable goes, it's got a double whammy. The UK really is becoming the poster boy for the stagflation risk that potentially is seen globally. So the market's using it as a bit of a litmus test. A lot of press talk about how the UK economy is going to suffer, going to enter recession, rate hikes are going to put the squeeze on. We've got obviously the cost of living crisis, as if it's the UK is the only place in the world that's suffering from that. But this Treasury Select Committee meeting today, need to see is the Bank of England going to be pushed towards hiking even faster than they expect. Whether that gives a lift to the pound, if that's the market, is another question, or whether any lift to the pound can be sustained. But again, if we're matching it off against the US, it's a two-way trade, and at the moment there doesn't seem to be any reason to turn that round. So I still think there's potential that we get a test of the big 120 level, and what happens there could be decisive. If we hold on a first test, we could see a relatively strong bounce. Conversely, if it breaks that level, we could be heading all the way back down to the virus lows, down around that 115, 114 mark. Take a quick shift over to the dollar yen. Little bit of a slip overnight, but it's gained back. Again, I'm waiting to see, are we going to hit a consolidation phase here? My marker for that is going to be up towards those highs 131s and down towards 127. A decent range for this pair to develop if there's no big news to come, if the markets are going to be trading around the expectations for the Fed and that sort of thing. We know pretty much from now they're going to be hiking at least 3 times 50 pips. over the next 2 or 3 meetings, then potentially we get a pause. So as far as the market is concerned, it knows pretty much where the Fed is now. We have got this data coming up. We have got retail sales coming up, and that can be a very, very volatile number, and it's going to cause more swings, at least short-term noise in the dollar, and particularly dollar yen. We saw that with the CPI last week. We're going to see that with retail sales if there's a big variation. Now, the market is really going to question the Fed's policy path if we get a poor number. If we get a good number, it's likely to react similar to how the CPI, which missed and came in lower, but not as low as expected. And so some of the, we call them peak inflationers in the US, didn't quite give them their narrative because it kept inflation pretty high. Well, the same can be said for retail sales. If we get a decent number of retail sales, that'll keep the market saying, yep, the US economy is potentially going to be able to wear these rate hikes for longer. And so that'll keep the Fed policy in place. We could get a move up in dollar yen. How high it goes, I don't know. If we get a move up to sort of the higher 130s, perhaps, then we can potentially look at seeing if we can trade this range up towards that prior high, up around here, 130, 80s, 70s, 80s. If we get a test as high as these recent highs and we hold, that's a place I'll be looking to short at least to try to keep this range, see if it holds. But if we get a negative number, and depending on how negative it is, that could tip the apple cart a bit on Fed expectations, get the market drawing down, writing down those expectations, and we could see the yields drop and the dollar yen drop quite hard. Conversely, we'll see the dollar gain, we'll see euro, pound, Aussie gain against the dollar in that reactionary move. So that's tomorrow and something to keep an eye on. Quick look at oil, looking fairly upbeat today. That's obviously having an impact in dollar CAD, at least keeping it from gaining back higher. We did see on Friday a big move down in dollar CAD. It broke through, got some sort of mild short-term support resistance area, which was around about this 129, 50, 60 zone. We broke down through that. We had a test below, got down under 129, but it's bounced strongly again. But what we're finding is it's not being able to hold above this level again. This is why we highlight these levels on the charts. This is why we look at these zones when they have a say in things, going back to early May, it was resistance, then it became support. We had a false break back above, became a support. Then we had the break under, and we're not getting back above again. So this little area here, the 50s, 60s, is the number to watch at the moment. And you match that off against the recent lows down towards 129s, and up at these recent highs, this 30, 50, 60 zone. Just to take it on a wider time frame, for those that don't know, this is a big area that I was watching for quite some time, one of the more on a long-term basis, pretty much from 129 up to 131. Because technically it's a big zone, lots of stuff going on there. We got fibs in play, we got moving averages in play, and I started off all right by shorting into this zone and letting off in the dips down in the low 129s, but then I made a real hash of it last week, trying to mess around with my own strategy, mess around in the middle. Ended up trying a long break of 130.50, which failed miserably. Then I revenge traded it a bit, going in again and getting spanked on that. So I didn't stick to my plan, but this is a zone that I should have stuck to my plan in shorting into this zone and see where we go. And as I say, to really see a move back high, we need to crack above 131. And if we get that, then we've got the potential to move up to the 50 fib up here. And that opens up the sky pretty much. But until then, we are holding the bottom of this zone. So again, another little range to look to trade. So pretty much that's it. All I've got myself this morning. As I say, it's a Monday, so we're just pretty much getting set up for the week ahead. Quick look at US yields. We're off those highs again. Not doing much from Friday. bit of sideways action, see what the US has to do when they come in shortly, whether the market's going to kick on or not. As I say, keep an eye on that New York Empire State number just for the first indication of manufacturing for the new month. So let's take it to see if there's any questions coming up in the chat. Any if you guys and girls want to ask something, feel free to go ahead. And as I say, we can talk about anything really. If you guys need help with some aspects of your trading, you know, this is the place to ask. It's something I'm going to develop over the weeks ahead, talking a bit more about maybe trading psychology, looking into how markets function, looking at some of the things that perhaps you don't look at normally. What I will do is show some of you guys and girls what we've got to offer in the Forex Flow platform, because some of you are coming from outside, maybe seeing ForexAnalytix and what we do here for the first time. So this is the main dashboard that we've got here on the ForexAnalytix platform. There's a lot of things going on, a lot of analysis going on from all the team members, as you can see here. Updates on various currencies, loads of currencies to pick from down there. This is always updated on a weekly basis, and there's some analysis done on a daily basis. From my perspective, I'm looking at market orders. So you can see here we've got the Forex Orders, which is a snapshot of orders from the bank market, the interbank market, that I get in the morning from a contact. So it's, as I say, it's a snapshot, but it tends to give you the levels, and what we look for is where potentially stops are building and the bigger levels. But it gives you a guide and an idea of some of the levels that are in the market, where the orders, where the bids and offers are. What I also do, particularly on a Sunday night, is I look at the options for the week ahead. And as you can see, we've got a couple of pictures in here. This one, for example, which is the dollar yen. This is a snapshot of all the expiries by strike over the coming week, so Monday to Friday. It gives you an idea where the biggest strikes are. At the moment, you know, sort of 1.3, 1.4 billion is the biggest at 131. That isn't really busy at all in this pair. It's been fairly quiet for quite some time. Usually reasonably busy is if you get strikes that are sort of 3, 4, 5 billion. That's a reasonable number, but we're not getting a lot of those in this pair at the moment. So that gives you an idea, you know, where the busy strikes are, because then it can give an idea of if the market's going to gravitate to certain levels or around certain levels at particular times. That's then broken down over the week. As you can see from these bubbles, it tells us where the bigger expiries are. So for example, if we look here, we've got just over 1.3, maybe 1.4 billion expiring this week, and we can see where that's mostly contained. One big expiry on Thursday, 915 million at the moment. So this gives you a snapshot, you know, which days are busier, where the options are located across the week. So as we can see, Thursday far outweighs the rest of the week. And that can give us, as I say, that can give us an idea perhaps where prices might gravitate if things are quiet, if there's no big news coming, no big events. If we happen to be in the ballpark of some of these expiries around the expiry time, then we potentially can see some moves. Plus, it also gives us an idea which way the options market is looking, which way it's leaning, where the biases are, where it seems to be hedging more than the others. And we do that for several pairs. I think I look at maybe about 15, 17 pairs, and anything that's important I put up. So here we see the euro dollar. We can see that most of the strikes are situated to the upside, very little on the downside. That's been the case for quite a while. There was not a lot sub 108 when we broke through there a few weeks back. There's not a lot sub 105, and that's something that also can affect the pricing, because if there's a lack of hedging in the options, then that can cause options traders to have to chase to cover gamma and delta positions or hedging. But also it means they have to chase because they're not prepared, or they haven't been hedged for the downside. So it can cause a little bit of a chasing in the market, and indeed pushing euro dollar even lower. But as this is an overview, As I say again, this is where all those expiries are split over the course of the week. So again, Thursday is the busiest day. The biggest expiry of the week at the moment is at 108. So, 400 pips above. Not really much around current levels at the moment. As you can see, a lot of it's all situated above. And then I break down into the expiries day to day, and I do this every evening or first thing in the morning just to put up the expiries for the day ahead. Here's some of the other expiries of note this week. Dollar CAD particularly has got a big one, 2.44 billion going off Friday at 127.30. We keep an eye on it. If we happen to be down in that sort of price area into Friday, that may be something that would affect the price. So, as I say, let's have a quick look at if there's been any questions. Richard, can you show me again the cheat sheet? What's the cheat sheet? You can just let me know what.
I've put it on there already. It's a snapshot.
Oh, you chucked it up, mate. Okay. Cheers.
And good morning, everybody.
Yeah, morning, Kay. Just let everyone know, it's my colleague Kay Man who's in the platform with us. He'll be popping in from time to time and potentially going to get some other people popping in now and again, some guests, just to air their thoughts and give a bit of colour to the markets. There's a question here from Arif. How do you stay in a winning position despite scaling in? My main bread and butter, if you like, is long-term trading. I prefer to get in trades for the long term rather than scalping. I've never been a very good scalper in FX markets particularly, although I have had to learn to short-term trade more and more over the last few years, pre-2019, 2020, because we saw that big volatility drop off. But generally, no matter what trade I'm doing, the key is always to try and stay in as long as possible. I don't really set targets for my trades. When I'm entering a trade, when I'm planning a trade, a profit target is the last thing I look at. All I want to do from the outset is get in a trade, be happy I'm getting in a trade, plan my risk, know my stop loss, and try and do everything as I can to get my risk down to zero as fast as possible. That is my only consideration for a trade. Now, staying on a trade, what I then want to do is just run it as far as it goes. So if I, for example, start buying euro dollar at 104, I may have a stop, short term 103, 75, 60, or I'll plan it against whatever levels are about. If it moves up, then what I tend to do is if it goes up 10, 20, 30 pips, I take some profit. I take partial profit on the trade, be it a small slice, a quarter, half, a fifth, whatever I feel is necessary at the time. And then what I might do is start bringing my stop up behind. So I'm locking in a bit, I've taken a bit of profit, put some in the bank, I'm bringing the stop up on the rest a bit more, just reducing that risk. And what I want to do is if the price moves in my favor, I want to bring the stop up further behind, get it to entry at the very least as quick as possible, and then hopefully into profit. But what I want to do is run the profit as far as I can. And the way I do that is twofold. It's by looking at my levels that are above. There's no point looking at a chart, plotting your levels, support and resistance, and then you use one lot of technical analysis or technical indicators, say support levels, to get in a trade. And then you stick a 200 pip target on it and you ignore all your technical levels that are potential resistance. To me, that's pointless. That's the wrong way to do it. What you need to do is plot your levels. If you're long a trade, like let's say I'm long euro dollar 104, well, what's the next levels above? 104.20 was one. Let's go into a chart and then I can probably highlight it a bit better. So here, if you're buying off 104, then you've got potentially got resistance into 104.20. So what are you going to do? Are you going to just sit back and go, well, I don't care about that resistance because I want it to go to 106? You can't do that, especially when you're short-term trading. You got to think, what am I going to do here? Do I take some money off the table? Bank 20 pips on a slice of the trade, get my stop up maybe 5, 10 pips just to lock in the rest. And that's what I do. And if we break that level, then I look at the next level. Well, the next level's up at 104.40. What am I going to do there? I've got a question to answer. do I take a bit more off, then bring the stop up a bit more? And that's how you try and stay in a trade as long as possible. And I know it's a big fear for traders that they get in a winning position and they're scared to lose that money, so they take profit and they take it all. You don't need to take all your profit unless you're subjected to FIFO rules or regulations like people are in the US, where you can't actually cut a trade, take partials on it. Obviously, you've got a problem if you're doing that. You've got to take your profit or not at all. But if you are in a situation where you can take a partial profit and your trade size is big enough to do that, that's my advice for trying to stay in a trade. And trades like that, you can sit in and you can potentially run them for 200, 300 pips if the market happens to go your way. And all you do then is just take a bit off, move your stop up, take a bit off, move your stop up. And that's what I tend to do. So I can do lots of these trades and take, if it doesn't work, maybe I've taken 10, 15 pips on half the trade and the rest get stopped out for break even or net zero. That's fine with me. If my worst case is I've got myself to net zero, I don't care. I'm not losing. And that's the idea. That's the name of the game. Don't lose. And then if you do hit one of those runners that pushes up, you're in the trade, you're staying in the trade, you're pushing it as far as it can go, and you're locking in your profit behind you with the trailing stop. Let's have a look. Have we got any other questions coming up? All a bit quiet this morning. We've got the Monday morning blues. Dom's saying every time Bailey opens his mouth, GBP loses 100 pips. Something K-Man pulled up in for a lot of the central bankers that the comments before the statements that they make at central bank meetings, and then when they actually start talking, the opposite happens, or they knock it down and the market moves the other way. So, yeah, big risk for Bailey here, how it's interpreted later on this afternoon. K-Man, I don't know if you want to chip in, if you've got anything you want to add for this morning.
Yeah, just to stay on the psychology of being in trades and staying in trades. There's something, either you purely trade technical and then you don't ask yourself too many questions, and you handle it like leveling to level, which a lot of people are doing. But if you, as we are more not more, but at least looking equally at the fundamental side of things, there's just a few questions that you have to ask yourself whether to stay or not in a trade without going out of the trade at the first question that you ask yourself about a trade. I mean, it's like why do I trade the trade? Why am I in it? Is one of the preparations to take on a trade. So if, for instance, you think euro dollar has gone far enough, or the ECB members are starting to change tack, and you feel like, all right, it's gone far enough, now we'll try the other way around, is what happens after they speak? Are they creating enough room in the market for me to stay in a position? And also asking the positive questions, if it's good enough, yeah, let's go, and maybe even add to a trade when a certain level breaks on the top side, and then manage your P&L from there. But as Ryan rightly said, if you get to a worst case scenario where you're flat, I mean, that is great, because the next opportunity will always be around the corner, and you will have the opportunity to get back into a trade. That is one of my biggest mottos in life, or at least in the life of a trader, is always make sure you can do the next trade. So don't go all out in one trade. It never, well, it's gonna work maybe once in a generation, but in principle it never works that way. Don't put all your eggs in one basket, at least not volume wise. You always have to be sure that when the next opportunity comes, you can do the trade. So you have to not only manage a trade, but also manage your account on the back of it. So I think that's one of the most important things that I learned, and I can convey to people is like always make sure to be able to do the next trade, because there are a lot of opportunities. Whether it's been moving a lot lately since the pandemic. Everything is gone into an accelerated way, so there's always going to be opportunities. Look at dollar yen, look at the euro, the cable, anything really, and crosses. If somebody doesn't feel like having too many dollars because they don't know what's happening to the dollar, go and have a look at the cross. Look at the euro sterling, look at the euro yen, look at stuff like Canada yen, which was an absolutely great trade over the pandemic, since oil was flying, and and the Japanese are big energy exporters, and Canada is a producer, just like the Noki, just like when the commodity prices exploded, when Aussie and Kiwi were in demand. You can do crosses. You don't always have to be in the dollar, but at least make sure to be able to take the next opportunity.
Yeah, that's 100%. And it also depends on what strategy you're doing. If you're doing an intraday scalp, then you may put your risk on a 20 pip stop. Use this example, euro dollar here. You want to buy it at 104. Where's your stop going to be? It's potentially under the list line here, 103.90, and you'll put your risk in it. But if you're trading longer term, and what I do, particularly when I trade longer term, I don't put all my risk on one level. If I'm trading longer term, beginning of this year, euro dollar was potentially the trade of the year for me, because of the difference between the central bank divergence. The Fed going everywhere they went, detailing their path, then obviously the euro playing catch up, or the ECB playing catch up. So then you get the shift in the monetary policy divergence, and that should be reflected in the currency. But then we got the war, and then we got all this inflation stuff, so it changed the picture. I wasn't ready to buy the euro, or I actually was buying the euro at 105.10, off that big level there when we were touching it, and I had some success, just letting some off at 105.50. But if I'm trading long term, I pick my levels over the wider time frames and I scale in. So I may say, okay, I'm going to risk 1, 2, 3% on this long term trade, but it's not all going to go in one entry. I'm going to spread that down, maybe from 105 all the way down to parity, and then I'll have my assessment points. And as Kay says, it gives you room to stay in a trade. You're not betting the farm on one trade, so if you go offside, it's not so much a big deal. Because you've risked all you wanted to risk on one entry. Scaling your entries, spread the trade out a bit, gives you a bit of room to maneuver. You don't need to get sucked into all the near-term noise. But just quickly,
this is
got me
into the next question from Arif. How do you reset from losses psychologically? But that's the thing. It should all be in the preparation.
Yeah. If you get your prep right, there's no surprises.
I'm not saying it's not hard to lose money. It's always hard. We're always going to be psychologically affected by a loss. I mean, don't let anyone tell you are not going to feel a loss. But the preparation and already knowing what you're going to risk in a certain situation is going to prevent you from going absolutely down, feeling down if you take a loss. And they'll know we didn't ignore you. We're just going over one by one.
Yeah, I mean, Arif asked, do you ever trade with no stop? I don't. I always trade with a stop, even if it's what I call a disaster stop. There may be times I trade longer term and I don't have a real proper idea where I want to put my stop. Maybe because I'm trading over such a wide price range, but I will always have a disaster stop in, something that's maybe well below where I'm entering, just in case something happens, just in case there's a flash crash or anything like that, a disaster, and you're going to get stopped out. Yeah, you're going to take a hit, you're going to take a loss, but it's not going to be a wipe account loss. So yeah, always trade with a stop. It's part and parcel. you should know your risk before you enter a trade. You should be prepared for what you are going to lose. It's like a boxer. A boxer knows he's going to get punched in the face, so he prepares what he's going to do if he gets punched in the face. If you're walking down the street and you get punched in the face, you're not going to see it coming. You're not prepared for it. It's going to hurt more. And that's the same way with trading. You know, it's up to you how much you get hurt. You can either get prepared to get hurt or be unprepared to get hurt. And I'm always rather be prepared. So yeah, let's go back to Dale. He was asking about dollar rand. That's one for you, Kay. You tend to trade that quite a lot.
On the dollar rand.
So if you want to have a look at that.
Yeah, just put it up.
Yeah, let's bring it up here. Have I got it in my lot here? No, so let's put it up.
I'll be going over it relatively fast because I haven't been trading a lot of it lately.
Yeah, there you go, mate. Anything you want? I'll chuck a fib in there.
Yeah. All right. So we're on this. What is the fib? We're just right on there. 1634. Yeah, that was a level that I already highlighted in the room as well. In the 1630s, there's a bit of traffic going on. We are seeing prior high lows or lows, and then highs we just went through there. It's a very interesting level. The rand is a bit of a strange one in the emerging markets community, because it's even though we saw this big risk on, let's say, rally or liquidity rally, where dollar rand went down below 14. That was, in my opinion, a little bit of an anomaly. But there's an issue in South Africa with Eskom, the energy provider, who can sometimes put pressure on the economy just because they have like power cuts all over the place. So the rand is not really a currency that I'm playing a lot long in South African rand. But I do think we are on important levels right here in the 1630s. So they are really worth paying attention to. Do it on a daily basis if we break or cap in those mid 36s, in those mid 30s, even I think it's like up to around 1640. So pretty important zone here. If it caps, we can go back to mid to high 15s, I reckon, but therefore there should be a little bit of weakness coming up in the dollar itself. So that about for the rand. I'm much rather confident still on the MEX, for instance. I've got, as the people in the room know, I've got a pretty exotic cross on, which is long MEX versus short CNH.
Yeah, lovely one, that one. Yeah, and you've had to do that via crossing it through US dollar because there's no direct cross.
Because there's not a lot of platforms who really allow to trade straight across. I haven't seen one yet, so I'm going through the dollar, but it does eliminate a bit of dollar risk, and it does reflect my view of like the China still being in a slowdown, PBOC being in, as you said earlier, in relaxing the policy path where the Americas are, and the Fed especially, but what gravitates around as well when they are rather in a tightening. Banxico raised the rates again, 50 BPs end of last week. So it's pretty fundamentally decent trade, I think, still to be in.
Yeah, and just jumping back to the rand there. I mean, you know, looking at the chart, it looks, you know, fairly technically sound. You got a big level up against that fib. It's hit there and held there twice now. We're looking at twice now. Support, you know, got an area down towards the old 38.2 fib, and then down around 1550 looks to be a fairly decent level as well. So, you know, plenty of room there if you're trading it and want to be looking at shorts. You've got some decent levels to look at in there. You know, for whatever you think of South Africa and what's going on in the fundamentals, you come back to the charts and you pick your levels and you decide what you want to do against it.
And just had a quick look. It's 1605 10-ish. should be your first support zone if we fail. If you confirm back below down there, it's 16. It's going to be ready for a reversal, it seems, and double top in place.
Cool. And quickly, let's have this. Michael has asked about NZD CAD. Not one I can say I trade.
No, me neither. I'd rather see them trade hand in hand than yeah, even though the cross moves.
Yeah, I mean, obviously you've got to, with the CAD involved, you've got to be looking at oil. But again, here we have a central bank that in the RBNZ that's looking to hike. We're looking at more hikes to come. I think the bar's been lowered a bit on expectations on whether they may go 50 basis points. So it's looking more like 25 basis points. But obviously we're not seeing the currency gain into a hiking central bank. And on the other side, the CAD with oil moving higher, this is a bit more susceptible to oil moves here, as we can see, you know, CAD gaining on this one as oil's moving up to that 110 handle. So looking a bit bearish at the moment, but not really one I'm trading, Michael, or look at a lot, I have to say. But, you know, we're happy to do that and look at these things as we go along. That looks like it is.
And there was a question about yen crosses.
Okay, yeah.
Dale.
Yep, so yen crosses. Which one do you want to look at? Euro, yen. A bit of a, looks to be a bit of a divergence between maybe the pound guppy, purely on the euro sterling swing, if you like, the difference between them. But it's again becoming a bit more of a, you know, moving with risk, moving with yields. So it's pretty much in lockstep with what's going on there. There was a bit of divergence coming in now and again when you know, the dollar was being affected in dollar yen. Again, K-Man, you trade this a bit more than I do.
Yeah, I mean, interesting to note is that the bottom of the correction there is there's a small line coming from where was it, like mid 2021. That there's 3 peaks if you go a little bit further, closer to today, Ryan. Yeah, the April, July there, in the middle of April, July 2021. Trend line over the high in October, over the high in early 2022, and we kind of bounced from that trend line last week, but it was really fast, right? It was a really fast move. It coincided roughly with the lows we've done on the S&P. So we've got a little bit of risk on, risk off back in the yen after the huge dollar yen rally. The risk correlation seems to come back a little bit more in the yen pairs since last week and a half, really. And that coincides with the US yields coming back a little bit, trying to stabilize, and then after that, with the delayed reaction, the equity markets came off. So, but it bounced from that mid 132 in the euro yen, which is interesting on a technical point of view. Relatively, I do see it more in a range because euro yen could go a bit higher as the ECB expectations rise, but Bank of Japan still not seeming willing to let the rates take off. We'll have to wait for that a little bit. So probably I'd stay traded on the back of on the back of stocks, really. If
you're looking at a divergence ratio, if you like, between the Bank of Japan and the ECB, who wins out if they both turn hawkish? Does the ECB win out, or does the Bank of Japan win out?
It's probably going to be the ECB in the actual interest rate moves, but the psychology might be different. Because if Bank of Japan would move all of a sudden, there's heaps invested in short yen, in my opinion, still, because the Bank of Japan doesn't seem to be moving before the year 3033. So
yeah. So lots to look at there. So if we do get the Bank of Japan moving, it's going to be a big shock move compared to what the market's expecting. When you're trading expectations, it's all about where the sentiment lies, which way the wind's blowing. The market knows the ECB is turning into a more hawkish stance. The Bank of Japan are still flat out easing. So if you do suddenly get a swing there, it's going to be some big moves coming.
Yeah, very big.
That's what you need to watch for.
And right, in the meantime, if you want to do yen crosses instead of dollar yen purely, you really have to look at what the other currency is doing. I mean, sterling yen, is the sterling strong or weak? Canada yen, is oil or the Canada strong or weak? Same for the commodity currencies, the antipodians. It has a little bit more to do with the other currencies than the yen, because let's say that the yen, Bank of Japan, the yen fundamentally is in a stability for a weak yen, but the rest of the other currency can impact the cross perhaps more than the yen right here and now.
Yeah, very much so. Okay, well, that's pretty much it for today. I just want to draw your attention quickly, because as this platform, this webinar is now open to everybody. If you do want to come and join the ForexAnalytix platform, where you can get all the goodies and get to speak to us all the time, you can find that out on my website, forexflow.live/platform. And they're here. You can have an exclusive 20% off your subscription. That's for the life of your subscription, just by using the code there. So you do want to pop along, please do. Keep an eye out on the ForexAnalytix site for the trials that they sometimes run. $1 for 10 days. You can just come and have a look. But then if you want to sign up full time, please take advantage of the code there. And also the ForexAnalytix Traders Funding Program. Again, you can find the link on my website, forexflow.live, up in the menu here. You can get all the details there. If you want to look to scale up your trading, then we've got a great program here. One of the major benefits, particularly for US traders, is that it gets around the FIFO rules, because it's done through an intermediary, through a broker ACAP. You can do the slice and dice strategy that we employ, rather than the first in, first out regulations that you're stuck with there. A lot of our guys in the US are using this and making a great success of it. So thank you very much for coming to the show. This is just the start, so don't worry if you didn't get a question in or worried about what we're going to talk about. This is the first real day of launch, so got a long way ahead of us yet. And thank you very much for coming. I wish you good trading today, and we'll see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.